I want to compliment all three of the presenters for sticking to the time constraints that I imposed on them. I did that in the hopes that we would have lots of time left, because I am anticipating that we're going to have lots of discussion. But before I open it to the floor, I have a few questions that I would like to address to the panel to try to get our discussion up here going. In fact, I have 4 questions. Let me start with the first one. And this question I'm going to direct to both Sasha and Florian, although Aurora, feel free to also join in. And this question is, although there's no disagreement between your 2 papers, there is a slight sort of, let's say, interesting juxtaposition about the way that we're thinking about the relationship between lender of last resort interventions and market activity. So in some sense, Sasha's paper is arguing that lender of last resort activity sort of undoes certain kinds of disciplines in market transactions among financial intermediaries in particular. And in Florian's paper, there's, especially in the evidence about the effect for Italy and Spain in having greater access to supply of interbank credit as a result of the lender of last resort interventions, which I'm not sure if these are contradictory or complementary, but I thought it would be interesting if you 2 wanted to comment on how you think about juxtaposing these 2 sets of results.
Yeah, thank you for this question. I think I thought about a similar point. I think, and also we got this comment from someone from the Fed saying that you cannot have meaningful policy interventions by the central bank without actually reducing market discipline, because there is somewhere a failure in the market, like a distorted interbank market, or in maybe our case also other forms of private suppliers of capital. So I think this is a valid concern. I think what we are particularly interested or concerned with is that maybe even in the medium and long run, that they sort of like the fundamentals that led to this market distortions actually are not going to be reduced, like banks using cheap credit, buying excessively high risky assets, and this is what actually led private suppliers of capital to reduce their funding in the first place. And that, given that now basically a sort of deposit-like insurance from the ECB to other private creditors, this kind of motivation is going to be taken away. So I think this is our major concern here.
Yeah, I was just remarking to Sasha that next step is that we should join the papers. I'm not sure I see that much of attention, because Sasha shows that some funding came back, and that's what we see. That's how you can interpret that some funding comes back. Of course, the next step, what we want to do in the next paper, is to bring in bank characteristics, which we haven't done here. It's purely at country level. So it could very well be that the banks the money goes to are the ones that are the safe ones in Sasha's paper. So we don't know. I mean, I think it's fair to say that definitely in the case of Italy, maybe not so much in the case of Spain, is that the Italian banking system as such didn't have much of a problem over and above the sovereign debt that they were holding, and this had been taken care of through the ECB's various actions. So I think what's and the final warning maybe is that a limitation of our paper is that we're really looking at the shortest possible interbank funding. It's overnight unsecured, and it's not obvious to interpret this as classic funding. It's really liquidity management, right? You don't go to the overnight unsecured market to really fund things the same way you would go to US money market funds, even though it's short term. It's this really overnight treasurer's liquidity management. So it could also be that the economics there is working out slightly differently, and we only have that very short segment of the market.
Following up on this question of how much market discipline is eroded, I thought that Aurora, your finding might be somewhat relevant here, because if I understand it, you're finding that relatively strong banks are experiencing the advantage of being able to continue loan supply, so that you are seeing in the differential loan supply what might be considered at least a symptom of some market discipline. Do you think that's a reasonable interpretation?
Thank you, Charles, for the comment. So, yes, what I found is more precisely that I assess to what extent the financial position is strong and how this financial position allows the bank to offer better credit terms during a banking crisis when other banks tend to increase their interest rate. And what I found is that these banks with a strong financial position, especially in terms of capital and liquidity, are able to offer to lend money at a lower rate than other banks at a time where the interest rates are supposed to be really high due to a confidence crisis. So I totally agree with that.
Let me turn to Florian for another question, which is, you have this very interesting difference between the banking crisis initially and the sovereign debt crisis in terms of the way that these impulse response functions work. I know your presentation was a little bit brief, so you didn't spend a lot of time on the economics of why you think the responses would be different in those two circumstances. So I thought it would be useful to just get into that a little bit more.
I think, yeah.
You should summarize the result for people who may have missed it.
So that's a good idea. So what we see is that in the financial crisis, so roughly speaking, from Lehman to, we put it in the mid of 2011, but you could argue that the sovereign debt crisis started a year earlier in Greece, but we're talking really, what we mean here is really Italy, Spain, middle end of 2011. So what we see in the financial crisis is that there's not much country differences. The banks in Spain, Italy, Germany, they respond, the markets there respond the same way. Whereas in the sovereign debt crisis, Italy and Spain stand out. Greece is too small and Germany is our benchmark. And, I think of it that at some level, this is classic illiquidity versus insolvency. I think the financial crisis was a classic illiquidity crisis where, they held assets that were bad, but the size of the subprime market or some of the other dodgy things that bank world were doing weren't really big enough to question the entire banking system. Maybe one here or there, but not overall. Whereas the way it was then handled and the way it developed, that the sovereign debt crisis really fundamentally questioned the solidarity in a monetary union, that then basically put a big question mark on the value of sovereign bonds. And since the fact is that the banks in Italy hold Italian bonds, the Spanish banks hold Spanish bonds. I mean, it's more than 95% of own country. I mean, Sasha has been working on that. Suddenly it looked like, this banking systems, if all your formerly, or still AAA assets that hold no, against which you have to hold no capital because Basel puts a zero risk weight on this, all this stuff is now deemed very risky. Suddenly the banking system is at least perceived to be insolvent. So I think that's really the difference, why Italy and Spain were thought insolvent, and the economics of liquidity provision might play out very differently in an insolvent banking system than an illiquid one. Because illiquid one, the country doesn't matter. In the insolvent one, it matters where the insolvency is located. And it wasn't located in Germany, quite on the contrary.
So your if I can just paraphrase that last point, it was more of a sort of country fixed effect that's driving, therefore, a country supply effect in the sovereign crisis. If that makes sense.
Yes. I mean, I think you could maybe be more precise and look at individual banks in a country where the country is maybe not so affected, but the particular bank is more. But I think the evidence is that the nexus between the banks and the sovereign has become so strong that in that period, it didn't matter whether you were a otherwise healthy Italian bank. The fact that you were located in Italy was enough to question your solvency. So yes.
Yes, particularly I like this, or I also think about the solvency versus liquidity issue, but I think particularly if you are talking about lender of last resort of the ECB during the sovereign debt crisis, isn't this then to some extent problematic that maybe the amount of liquidity being provided was not, or was basically de facto insolvent banks, that there was no sort of credit quality which matters in this lender of last resort policy, but basically liquidity was provided to all types of banks, even to the almost insolvent ones, which then creates maybe different problem. I think this is maybe more where our paper is going to, that basically you reduce the collateral, or ECB reduced the collateral requirements substantially, so you couldn't, even with almost defaulted sovereign debt like Greek government bonds, you could at least until recently get access to ECB liquidity. But then you give the money simply to banks which would otherwise be just simply insolvent. Right? And I think this is why this market disciplining effect is maybe an important concern.
Before I let Aurora come in, because I know she wants to say something, I think this is the crux of an issue that's been concerning me, which is if it's truly collateralized based on reasonable haircuts, then that's what I call, lender of last resort traditional assistance. But I think your point is that in some cases, these haircuts are not commensurate with any reasonable notion of sovereign debt recovery, which is where you start getting to really more of a subsidized loan that subsidy is specific to particularly the countries. It's not just the cross-section of the banks, right?
And also not only that, it's not only sovereign, but basically all types of assets, even almost defaulted corporate debt maybe, and asset-backed securities, which can be used as collateral as well.
Yes. Aurora, you wanted to get into.
Yes, I just wanted to support what you say, Florian, about the difference between financial crisis and sovereign debt crisis, because when you study the credit supply after, so you were more dealing with how banks get their funds, their liquidity, but then when they have liquidity and you study how they lend it to the market, you still can observe a difference between the banking crisis and the sovereign debt crisis. Because during the banking crisis, the countries seems to react the same way, whereas you have a significant difference when you analyze each country during the sovereign debt crisis. So I think, yes, you have a strong difference between these two types of crises. So this is just to support what you say.
Before turning it over to the floor to ask some questions, I have one final sort of interesting question that's relating to Aurora's paper. So, to me, the most surprising result, if I understood it correctly, was that home bias is observed pretty much uniformly within Europe, with the exception of Spain and Italy prior to the crisis. And I think that was what I gathered from your discussion. And I was trying to understand that result, that is, the absence of home bias in Spain and Italy prior to the crisis. One interpretation, I suppose, might be that Spain and Italy are looking for, because of low productivity growth, what we heard about from Luigi Zingales yesterday, are looking for opportunities more outside their borders, because they're the places within Europe that are having this low productivity growth. But I'm not sure if, obviously that's asking you to go far from your database, but I thought it might be interesting to ask the whole panel if they had any reaction to that.
So, just to make sure that I have understood correctly, you talk about the absence of home bias prior to the crisis. So, this is something I can only observe in the data because in my analysis I took the nationality of the borrower after the crisis. So, I don't know how banks grant their credit according to the nationality of the borrower before the crisis. But what I can observe in the data is that Spain is really the exception in my sample because a large number of loans are granted to domestic companies by Spanish banks compared to Italy, for example, in terms of number of loans. Then I have to go deeper into the analysis to study what happens before the crisis. But just a first signal is that Spain tends to lend more to domestic companies than Italy, France, or Germany, even before the crisis. But I have no clue at the moment in the analysis regarding how they grant credit, if they offer better credit terms or not, but can be a good point to develop.
Let me just try to get clarification because I think I was misunderstanding something. So as I was looking at the slides, I thought the result was that France and Germany had home bias in the whole period, whereas Italy and Spain were only getting their home bias during the sovereign crisis. But I think I got that wrong. Could you just clarify that? Because it was one of your first comments, but I was confused by it.
Okay, so sorry for that. So the war period is the war crisis period. So for between 2008 and 2013. And when I make the distinction between the two crises, it's the banking crisis between 2008-2011 and the sovereign debt crisis 2011-2013, again because I'm studying Italy and Spain, so it's more relevant to take 2011 as the breaking point. But it's just the crisis time after the collapse of Lehman Brothers.
Okay, I think we can now open the floor to other questions that the participants might have. We have microphones too. Does anyone want to ask a question? And I encourage you, you can ask broader questions about the European banking crisis because we have a group of experts that probably could talk about more than just the contents of the papers that we've seen. Well, we're not seeing any questions. Do any of the panelists want to make any closing remarks?
Well, I would react a little bit to this provision of illiquidity to insolvent banks. First of all, maybe a more nuanced view of what solvency or insolvency. I mean, I personally haven't fully figured out where the line between illiquidity and insolvency in practice is. And one thing that we saw in Europe is certainly the presence of multiple equilibria. In the sense is that if you think that your sovereign is in trouble, your sovereign is in trouble, and if the sovereign is in trouble, you think that the sovereign is in trouble. If you don't think it's in trouble, it's not in trouble, and you confirm the expectations. I mean, it was completely, by no fundamentals could, for example, the problems in Spain of the Spanish sovereign, which had 60 or 70% of debt to GDP, be led to, to an increase in the spreads to incredible levels, whereas there were other countries which were maybe fundamentally insolvent. I mean, Greece had pretty high debt to GDP levels, Italy. So it depends on a number of factors. So I think the verdict, whether we were de facto providing liquidity to somebody who's fundamentally insolvent or who was perceived to be insolvent is still out. And what the ECB did classically with the OMT, the speech by Draghi, whatever it takes. I mean, this is, if you need any confirmation that there were multiple equilibria out there, I think that's it, because they just ruled out the bad equilibrium and we didn't have to do anything. So I think that's kind of neat. On the other hand, I'm not saying there weren't any problems. So we have the banking union, which By the way, I think people tend to forget, you know, if you talked about a banking union 2010, 2011, you know, you just dismissed, we don't need it, all is good, mutual memoranda of understanding are enough, with Dexia working out or not. And suddenly, you know, within a year, we have basically, you know, something where the money for resolution, for bank resolution is a national issue. It's always national taxpayers' money that's at stake. We suddenly have decisions being taken at the European level. So this was really a milestone, also how fast it went through. And finally, I mean, you know, of course, you know, maybe some observer might conclude that what the ECB did ex post wasn't great, but, you know, what should we have done? Should we have, in the middle of 2011, said, sorry, we're going to go back to auctions? I mean, I would have liked to see that. You know, the rates would have gone through the roof. Interest rates would be higher. That would have not helped growth, wouldn't have helped anyone. So in some sense, we are in an unlucky situation that national politicians don't do their homework. I mean, it's so frustrating to see how in each country, and I'm including Germany, everybody is focused on getting national elections won and is just promising whatever suits them, and there's really no single European politician of any weight in Europe right now. We don't have the whatever Mitterrand, Giscard d'Estaing, the Schumanns, maybe even Kohl. We don't have these people anymore. Everybody is national, and that's what I see as the biggest threat for Europe. I mean, you certainly cannot do common monetary policy with a very, very ill-existing absence of fiscal transfers, but you certainly cannot do monetary policy in a nationalistic Europe. So
can I just ask?
Huh?
Yeah.
Hold on 1 second. We'll bring you a microphone.
Do you need a microphone?
Yes, it's coming.
Oh, I'm so sorry, I don't quite understand what you are trying to say when you said that we don't have a Mitterrand or a Kohl. What do you expect the politicians to do right now?
Well, I expect them to realize that it's in everybody's interest to have a functioning European economic, maybe even political area, because most of our trade is among countries. There's also maybe non-economic benefits to you know, being together in the same boat. And what I observe is that it's everybody for himself. If it continues like that, we're gonna see a lot of problems, right? I mean, we have in your country substantial right-wing politics who are completely anti-European. We have them in Germany in the parliament. You know, we have them everywhere. So, you know, if that's the conclusion, that in Europe everybody is better off by himself, you know, I don't think we've learned all our lessons.
Let me focus this question again. When you're talking about European nationalism with respect to the banking system, there seem to be many pieces to it. One of them, of course, is the concern that the national governments are being too forgiving of their banking systems in exchange for the banking systems being too forgiving of the national government's debts, so that we'd rather be in a better equilibrium where the national governments are imposing stricter discipline on the banks in particular. But then from that perspective, of course, the concern is that we all understand the ECB feels caught, because the problem is without that discipline at the national level, you are stuck having to provide assistance, maybe even to these weak institutions. But I wonder whether the ECB is going to be able to solve that problem, and maybe that's where what you're talking about, by themselves. That is, what is the European solution to that problem? The ECB doesn't seem to have been so effective, I would say, in forcing the recapitalization of the banks in September and subsequently. There's been some effect, but maybe not completely adequately. So there seem to be limitations, and maybe that's what you're getting at, that without, is that what you're getting at, that without the national governments being willing to act more to clean up their own domestic messes in the banking system, that you can't progress as a region with the ECB's interventions. But I'm not sure whether you have in mind more the national fix or some sort of European fix to those kinds of problems, or am I just on the wrong topic?
No, I think you said it precisely. I mean, I think we have a. Maybe I'm biased, but I think from a. Huh? Well, then.
It's good to be converted.
No, I mean, I think it's very difficult for a single European central bank to do all the jobs that are needed to be done. And for example, cleaning up the banking system is not our job. But we cannot say, unfortunately, sorry, not our job. I mean, you're all to yourself. I mean, we could do that. We're doing it a little bit. I mean, for example, we told the Greek banks that they have to go to their own central bank to get liquidity now and no longer from the ECB.
Why
And
don't you do it for the French banks? I like to see that. It would be wonderful. That would be very effective.
to achieve what? Effective is what?
It's what you said, that,
So you're saying if the French banks are insolvent and need to be cut off from...
I'm not saying that, but there's certainly, some disciplines certainly will be very well. We use the microphone.
Let me take Florian off the hot seat for a moment while he's thinking, and just redirect the same comment to Sasha, because Sasha, in your paper, not the one you presented today, but the one that you did about a year ago with Viral Acharya on your S-risk measures, the French banks did come in, according to your estimates, as quite weak. So there's, and now I'll play my card as a representative of the Greek contingency, although not the current government, that discipline is often very selective in Europe.
Yes.
And the center countries, maybe they are able to avoid some of the same discipline as the peripheral countries. Is that a fair characterization?
Yes, so thank you very much for redirecting this question. Yes, so I think this is absolutely right. I think in our analysis, we have very different banks that came up as really undercapitalized compared to what the AQR comprehensive did find out. But I think also if you look at, so we did this follow-up piece actually after the results came out, just to investigate why our estimates have been so off relative to what the ECB actually estimated. And the interesting thing is, if you look at, so for example, our simple estimates of losses in our scenario are very, very highly correlated, which was the ECB actually finds in their scenario. So in that type of analysis, the ECB was actually very, very similar to what we have, at least in terms of a ranking of the banks. But then how we diverged was essentially, what do you do with the result? So our analysis was simply, okay, we need to look at something else than a simple regulatory capital ratio, because something that can be gamed by banks is not something you should actually make a regulation dependent on. We're saying, look at a simple book ratio, look at various ratios altogether, and try to find out what would be your verdict in terms of what bank is well capitalized and what bank is not. The fact that the ECB or the European Banking Authority then simply said, okay, we look at one measure, which is our Tier 1 ratio, and this is why we say, okay, we have a very few banks out of everybody basically in the Eurozone which have combined 20 billion euro capital shortfall, was essentially a result of that. And when we actually presented our results at the European Systemic Risk Board, there were some people who were actually responsible for that mechanism and said, okay, we're fully aware of that, but we just don't change that. So for whatever reason, I don't want to comment on the reason, but simply the fact that if you put two different metrics based on what you would like to do regulation, and then you get completely different results, and you need to ask questions why this is the case, and what methods do you actually want to believe in. And yeah, this is, I think, from our perspective, looking at some German banks, not to only exclude us Germans, but also some French banks, wouldn't be a bad idea, because they seem to be very, very highly focus on very, very low risk-weighted assets, which might appear much more dangerous at the end as they currently look like.
We're coming up at the end of our time. Does anybody, well, we have another question from the floor. Maybe we can take that before we get closing statements. Yes?
I have not looked very recently at the data, but my understanding is bank loan growth in Europe is very low. Okay? One interpretation is that the banks are reluctant to lend because they're still sitting on a bunch of crap, bad loans and so on. You're never going to get a sustainable economic expansion in Europe if the banks don't participate. So what has to change? What has to happen for that to change, for the banks to start lending?
I think that's a great question to maybe end our session on. Maybe each of you probably has something to say about that for a minute. Who wants to go first? Aurora, why don't you?
So with the paper I've written, which is about how banks take their lending decision, what I've learned from this paper is that in order for a bank to lend money or to lend money at a very interesting rate, first, one idea is that you have to have stable banking regulation which assure depositors and investors in general that the bank has a strong financial position, because you're perfectly right saying that if banks don't lend money to companies, the economic activity is not going to go up. And especially during a banking crisis, when you have this type of confidence crisis, banks don't want to lend to each other, even they don't want to lend to companies. So in order to limit this risk, I think the first thing to do is to set up a framework to regulate banks, not complicated, not something complicated to implement, to follow, but which assure each depositor that the bank is well capitalized enough, for example, to go over the financial crisis. And this will limit the risk that the financial crisis, which may happen, has consequences on the economic environment. And this relates to the presentation you did on Thursday, talking about having a banking regulation not influenced by politics, just because you want to keep this environment stable in order for banks to be able to provide loans to companies. And if you want to keep this stable, it can't change with every different president. So this would be one of the first part of the answer.
Thank you very much for this great question. I think I need to echo what Aurore was actually saying. That and I think what you're saying was exactly the second of the graph I put on. If you compare that to the US, strong credit growth being highly correlated with a growth of the economy. And I think we had a different, so I unfortunately don't have that graph here, but we looked at kind of a crowding out effect of banks who used the remaining balance sheet capacity that they had to buy sovereign debt, and that at the same time crowd out lending to the corporate sector. I think this was exactly, as you were pointing out, a problem of limited balance sheet capacity, undercapitalization, banks putting more emphasis on sort of not necessarily writing down non-performing loans, but rather extending loans to these types of firms in order to basically, because they're so simply capitalized. And this was the hope of the comprehensive assessment, to get actually rid of exactly that. But so I think we need to see what happens in the future. But the capitalization, I think, is a key point.
Yeah.
You're in the last word.
Oh. No, I mean, I think definitely that's something that we're very, very concerned, because that brings us back to classic monetary policy. Ultimately, we are after growth, and indeed, loan growth has been shrinking. Still, I haven't looked at the very latest numbers, but it's staggering how bad Europe has been doing that. And I think perfect storm again. I mean. It certainly didn't help that you're trying, and by the way, this holds for sovereigns. It doesn't help to tell the sick patient that he has to kind of now go on a diet, right? I mean, for the sovereign, it doesn't help to be saving when there are problems, and the same for banks. Banks were asked to recapitalize. And so what do they do to get the capital ratios up? They're certainly not able to get money from the market because we are in a financial crisis. What they do is they shed loans. That way you get your ratios up. And Basel is focused on ratios. And if you can't do anything about the denominator, you do something on or the other way around. You can't do nothing on the numerator, you do it on the denominator, right? So, and then of course it doesn't help, and this gets to the second point, is that for whatever reason, we are in a world of abundant central bank money. To hold the system together. With that money, banks go out and buy financial assets. Stock markets are booming all over the place. Why? Because on a risk-adjusted basis, this stuff looks better in the short term than lending to a small company somewhere. I mean, the banks do the rational thing. They want to make money the fast way, and they do it by investing in financial assets, stuff that carries little risk weights, and not go out through the trouble of screening small, medium enterprises.
That's a great place to end our discussion. I hope you'll all join me in thanking the panelists for a very stimulating session.